Imagine turning $1,000 into $30,000 in just 6 months. Now imagine losing it all in a single week. That's the reality of crypto trading. A digital gold rush where fortunes are made and lost with blistering speed. But what separates the winners from the losers? The answer isn't luck, it's strategy. Today I'm pulling back the curtain on the 5 proven crypto trading strategies that the professionals use to consistently profit in one of the world's most volatile markets. Whether you're a complete beginner or you've been burned before, these strategies could be the difference between riding the wave to financial freedom or getting caught in the undertow. Stay with me for the next few minutes. Your crypto portfolio will thank you. Strategy number 1, dollar cost averaging, DCA. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." This wisdom applies tenfold to cryptocurrency markets. Dollar cost averaging is perhaps the simplest yet most powerful strategy for the average crypto investor. Here's how it works. Instead of trying to time the market with a large lump sum, you invest fixed amounts at regular intervals, regardless of price. It could be $50 every Monday, $200 on the first of each month, or whatever fits your budget. Why does this work so well in crypto? The market is notoriously volatile. Bitcoin has experienced 6 drops of more than 50% since 2018, but still managed record highs afterward. DCA removes the emotional aspect of investing. When prices crash, your scheduled investment buys more coins. When prices soar, you resist the urge to go all in at the peak. A study by Bitwise Asset Management found that an investor who dollar cost averaged into Bitcoin between 2018 and 2022 would have generated returns of over 200% despite entering during what many considered a crypto winter. The beauty of DCA is its simplicity. Set up automatic purchases on exchanges like Coinbase or Binance, then let time and consistency work their magic. Remember, this isn't about getting rich overnight. It's about building wealth steadily while managing risk. Strategy number 2, technical analysis with key indicators. While fundamental analysis asks what to buy, technical analysis answers when to buy. In crypto markets, timing is everything. Professional traders don't just buy on hunches. They use technical indicators to identify patterns and potential entry and exit points. Here are 3 essential indicators that form the backbone of effective crypto trading. First, the Relative Strength Index, or RSI. This momentum oscillator measures the speed and change of price movements on a scale from 0 to 100. An RSI reading above 70 generally indicates an overbought market, suggesting a potential reversal and good time to sell. Readings below 30 indicate oversold conditions, potentially signaling buying opportunities. Second, moving averages. These smooth out price data to create a single flowing line, making it easier to identify trends. The 50-day and 200-day moving averages are particularly important. When the 50-day crosses above the 200-day, known as a golden cross, it's often seen as a bullish signal. The opposite, death cross, may indicate a coming downturn. Third, volume. In crypto, price movements without significant volume often don't sustain. Major price movements with high volume suggest strong market conviction, making the trend more likely to continue. The key is using these indicators together. No single indicator is perfect, but combining them creates a powerful framework for decision-making. For instance, if Bitcoin falls to a support level with an RSI below 30 and unusually high volume, technical analysts might see a potential buying opportunity. Remember, technical analysis isn't about predicting the future with 100% accuracy. It's about tilting the odds in your favor by making data-driven decisions. Strategy number 3, swing trading with market cycles. While day traders are glued to minute charts, making dozens of trades daily, swing traders take a more measured approach by capturing swings in price that typically play out over days or weeks. Crypto markets tend to move in recognizable cycles. Bitcoin, for example, has historically experienced approximately 4-year cycles, often correlated with its halving events. Understanding these broader cycles gives swing traders the context needed to make better timed entries and exits. Here's the approach. Swing traders identify assets in clear uptrends or downtrends, then look for temporary counter-trend movements, retracements, to enter positions. For example, if Ethereum is in a broader uptrend, but pulls back 20% due to short-term selling pressure, this might present an ideal buying opportunity. Effective swing trading requires patience and discipline. Set clear target prices and stop losses before entering any position. Your target profit might be 20 to 30%, while your maximum acceptable loss might be 10%. This creates a favorable risk-reward ratio. You're risking less than you stand to gain. What makes swing trading particularly effective in crypto is the market's inherent volatility. While this volatility terrifies many investors, it creates opportunities for swing traders who have learned to ride these waves rather than fight them. Unlike day trading, swing trading doesn't require constant attention. Check charts once or twice daily, set limit orders and stop losses, then let the market work for you. This makes it accessible for those with full-time jobs or other commitments. Strategy number 4, strategic portfolio. Diversification. Don't put all your eggs in one basket is age-old wisdom, but in crypto, proper diversification requires deeper thinking about correlations and market sectors. An effective crypto portfolio isn't just about owning multiple coins. It's about owning assets that serve different purposes and respond differently to market conditions. Here's a framework for strategic diversification. Start with Layer 1 protocols like Bitcoin and Ethereum as your foundation, typically comprising 50 to 60% of your portfolio. These are the established players with the strongest network effects and institutional adoption. Next, allocate 20 to 30% to sector-specific projects. Just as traditional investors divide stocks into sectors like technology or healthcare, crypto can be segmented into areas like decentralized finance, DeFi, gaming, privacy coins, or storage solutions. Each sector may experience different growth catalysts and adoption curves. Reserve 10 to 15% for early-stage, higher-risk projects with significant upside potential. These are your asymmetric bets, positions where you could lose your entire investment, but also potentially see 10x or greater returns. Finally, maintain 5 to 10% in stablecoins. This provides liquidity for opportunities without having to sell other assets, while also reducing overall portfolio volatility. Rebalance periodically, perhaps quarterly. If a particular asset or sector significantly outperforms, consider taking some profits and redistributing to maintain your target allocation. Remember that crypto moves much faster than traditional markets. What works today may need adjustment tomorrow as the technology and regulatory landscape evolve. Strategy number 5, yield farming and liquidity provision. While most strategies focus on price appreciation, sophisticated crypto investors generate returns regardless of market direction through yield farming and liquidity provision. Yield farming involves deploying crypto assets to generate returns, often in the form of additional tokens. These yields can range from 5% to triple digits APY, though higher returns typically come with higher risks. The most basic form is staking, locking up tokens to support network operation. For example, Ethereum staking currently yields around 4 to 5% annually for helping secure the network. This is essentially the crypto equivalent of earning interest. More advanced yield farming involves providing liquidity to decentralized exchanges, DEXs like Uniswap or Curve. By depositing pairs of assets into liquidity pools, you earn a portion of the trading fees generated by the platform. This can be particularly lucrative for pools with high trading volume. However, yield farming comes with unique risks. Smart contract vulnerabilities could result in lost funds, and impermanent loss can occur when the relative price of your deposited assets changes significantly. Additionally, some high-yield opportunities are short-lived or may involve tokens that rapidly depreciate in value. The most successful yield farmers diversify across multiple platforms and regularly compound their returns by reinvesting. They also stay informed about new protocols and opportunities, as the highest yields are often found in newer projects looking to attract liquidity. When implemented carefully, yield strategies can provide steady returns that compound over time, forming a valuable complement to the more growth-focused strategies we've discussed. Conclusion: the crypto market doesn't reward hope or hype. It rewards strategy and discipline. Dollar-cost averaging builds your position steadily without the stress of timing the market. Technical analysis helps you make data-driven decisions about entry and exit points. Swing trading captures the natural rhythms of crypto volatility. Strategic diversification spreads your risk across different segments of the ecosystem. And yield farming generates returns regardless of market direction. No single strategy works in all market conditions. The most successful crypto traders adapt their approach as markets evolve. They combine these strategies using DCA for core holdings, technical analysis for timing larger moves, maintaining a diversified portfolio, and generating yield where appropriate. Remember, the goal isn't to catch every move or make perfect trades. It's to consistently make good decisions that compound over time. Crypto wealth isn't built overnight. It's built through hundreds of smart choices executed with patience and discipline. Before I leave you, here's one final thought. The best trading strategy in the world is worthless without proper security practices. Use hardware wallets for long-term holdings, Enable two-factor authentication on all exchanges, and never share your private keys or seed phrases with anyone. In crypto, you're your own bank. Act accordingly. Whether you're looking to supplement your income or achieve financial independence, these 5 strategies provide a proven framework for navigating the crypto markets. The opportunity is there. Now it's up to you to seize it.